I sold all of my stocks and most of my crypto in November of 2021. Meet Kevin just sold 20 million in stocks and crypto. What the heck is happening? What are we thinking? Are we paper handing weenie babies? Have we lost our minds? Stay tuned to find out. Hey everyone, Rosario here, and welcome to Modern Finance. Yes, it's true. I sold virtually all of my stocks in crypto a month ago, and Meet Kevin just sold 20 million. Basically, almost all of his stocks in crypto a few days ago. What is going on? Well, here's the background. Inflation just hit 7% in the US and 5% in Canada. Those are the highest levels in 30 plus years. Jay Powell and the Fed are becoming hawkish. According to many news outlets, the Bank of Canada has a 75% chance of hiking rates on January 25th, and they're set to raise rates 7 times in 2022. Many are predicting a double rate hike by the Fed in March, 0.5% instead of 0.25%, and some are predicting an early hike of 25 basis points or 0.25% by the Fed on January 25th. That's tomorrow. Markets are already crashing, and they've been crashing for the last month. But the markets are forward-looking, and everyone is freaking out because increased interest rates mean reduced profits in the stock market. As such, the S&P 500 is down over 8% in the last month, and many tech companies have lost 50 to 80% of their value. Hedge funds and institutions keep selling every day, and the hodlers are getting rinsed. But when will it end? I believe the market will keep crashing until the Fed stops hiking rates, at least. But how long will that take? Meet Kevin thinks it will be until March 25th when the Fed finally raises rates and the market knows what's happening. I actually think the market will keep crashing until the Fed lowers interest rates again. But why do I think this? First, we need some background. You can jump past this if you already understand how central bank interest rates affect stock valuations. So how does the central bank interest rate or the Fed funds rate affect prices, the stock market, and housing prices? In theory and in practice, the price of a stock is the value of all future cash flows of a company discounted by when those cash flows will occur. Money now is worth more than money in the future, right? Well, how much more? That's where the discount rate comes in. The discount rate is the opportunity cost of owning something. For example, I could own bonds, stocks, crypto, or any other asset, but I can only put each dollar in one place at a time. So I need a way to compare investment options. The discount rate is calculated using the CAPM or Capital Asset Pricing Model. Basically, this discount rate for each stock, cryptocurrency, or other asset is dependent on the risk-free rate, or the central bank interest rate. So if the central bank interest rate goes up, the discount rate for stocks and other investments also goes up, and therefore the stock price goes down, if you value an asset based on this calculation, that is. Why? Because all investments are a comparison to other investment options. If a risk-free investment, for example, a government bond or a central bank, offers a higher rate of return with lower risk, then investing in a company will be less attractive. Hedge funds are selling because the discount rate is going up. So the cost of money is going up, and their valuations on tech companies and other companies are going down as a result. But why are interest rates going up? Central banks try to combat inflation by increasing interest rates. This theoretically makes people spend less and save more because borrowing becomes more expensive. Let's take it to the extreme. If you could get an interest-free loan for $1 trillion, why wouldn't you? You could spend that $1 trillion and it would cost you nothing. You'd never have to pay any interest back, and maybe you wouldn't even have to pay the principal back. But what if you borrowed $1 trillion at 0%, but then suddenly it went up to 1%? Now you'd owe $10 billion per year in interest all of a sudden. Oops. Rising interest rates make it less attractive for people to borrow money to spend it on things like houses, cars, and basically everything that people want. If people aren't spending money, companies will have to cut prices or at least raise them at a slower pace to get people to buy things again. Inflation is measured by the Fed and other central banks as the increase in prices year over year. So at least theoretically, if interest rates rise, people don't borrow as much, companies won't be able to charge as much for their products, and prices will stabilize or fall. But does this actually work in practice? Well, the last time inflation was this high was in 1982. The federal funds rate, or the central bank interest rate, in 1982 was 20%. The federal funds rate today is 0.25%. It's basically zero. The Fed has hit the zero floor. Interest rates have been essentially at zero since 2008. and they have nowhere to go from here. Unless the Fed can raise rates back to historical levels somehow without crashing the market, they're stuck. Is this possible? I don't think so, but others do. Even though they have a lot of room to go to where they were in 1982, I don't think they can get there. It just won't work. Most people think that raising interest rates will reduce inflation by reducing spending, as I mentioned before. Historically, though, that's not the case. Over the last 70 years, the Fed funds rate is actually positively correlated with inflation. That means that every time the Federal Reserve increases interest rates, inflation goes up. Could this be a post hoc logical fallacy, where correlation doesn't imply causation? Sure, but what are the odds that there is a 75% correlation between the federal funds rate and inflation, and virtually no correlation with other metrics? That means that whenever the Fed raises interest rates, inflation goes up, not down. So if inflation keeps going up when the Fed raises rates, when will interest rates stop going up? Well, not only will raising interest rates not stop inflation, rates can't go up because governments, markets, and people in the USA and Canada and all over the developed world are dependent on low rates. In a previous episode, I said that debt to GDP was 350% in Canada. But if you include all debts, not just government debt, so non-financial business, federal government, state and local or provincial government in Canada, households, and nonprofit organizations, that number balloons to over 1,000%. The US isn't far behind at 890% debt to GDP as of December of last year. With a national debt of over $30 trillion, the US government paid over $500 billion in interest on its debt alone in 2020. That's an average interest rate of 1.7%. As I mentioned in a previous video, referring to Canada, we are seeing some of the highest inflation numbers that we have seen since 1982, when the federal funds rate was over 14%, and the interest rate in Canada was similar to that. If the US Fed has to raise interest rates to even 10% to quell inflation, that would make the interest payments on the debt balloon to over $3 trillion per year. Right now, the $500 billion in interest payments make up only 5% of federal government spending. If the rate went up to 10%, that would rise to over 30% of federal spending. That would make interest payments on the debt the government's largest expense by a huge margin. And most of their spending right now is deficit spending. The government would be screwed. Currently, income security, Social Security, and healthcare are the largest expenses of the US government, followed by national defense. Basically, governments and central banks are stuck between a rock and a hard place. They can't raise interest rates because it will bring them closer to defaulting on their huge amounts of debt and slow economic growth even further, perhaps even crashing the economy. They also can't keep interest rates at zero because inflation is skyrocketing, prices are increasing at an enormous rate, and people are freaking out. Here's where this story gets really sad. The only people that are affected by high inflation, really, are the poor and the middle class. The ultra wealthy are insulated from the effects of inflation because their assets go up in value. And for the government, inflation is actually a good thing. It means that they can essentially evaporate their debt by paying it back with devalued dollars. Basically, stocks keep going up, real estate keeps going up, and everyone is happy except for the 80 to 90% of the population who is no longer able to afford food, shelter, clothing, or entertainment. Theoretically, in a democracy, that can't last. Of course, there are a lot of plans to continue implementing universal basic income to supplement this loss in purchasing power, but that will likely contribute further to inflation as it only adds to the debt that needs to be paid off and will put upward pricing pressure on everything because people will have more money to spend. So here's why I sold everything. I looked at the inflation rate, stock market returns, housing market returns, and the federal funds rate in the US for the last 50 years to see how they all correlated. As it turns out, real stock market returns are negatively correlated with inflation. It's a weak correlation, only around 25%, but it's still there. That means that often when inflation is rising, markets are falling, at least relative to inflation. Real stock market returns are also negatively correlated with the federal funds rate, about the same amount as they are negatively correlated with inflation. So basically, whenever the Fed raises rates to try to combat inflation, they crash the stock market. So I sold all my stocks because I'm a genius that predicted this crash based on the looming interest rate hikes. No, I'm not that smart. I I did it because I needed a home for my growing family. I did it to buy a house. I didn't time the market, although I did manage to sell at almost the exact peak for most of my holdings. I sold in November, which was basically the high point for the S&P. Meet Kevin sold last week after things had crashed already. He sold $20 million in stocks and crypto. I sold $350,000 in stocks and crypto. Meet Kevin is trying to time the market and buy back in when knowledge about interest rates hikes settles in and there's less fear, uncertainty, and doubt over whether the Fed will continue raising rates over the next 90 days or so. Problem is, I don't think we're done with rate hikes, and based on past experience, the market keeps crashing until the Fed reverses rate hikes, or at least stops increasing rates. For myself, I'll start buying back in, but only when I have the funds available to do so, and only when I find companies that I think will continue to be profitable in this environment. So when should you start buying again? Like I said, market returns are negatively correlated with inflation. High inflation means negative real market returns. That's not good. Holding on to cash won't help you either because your cash is being devalued constantly. It turns out real estate is also negatively correlated with inflation to the tune of about 26%. That's even more negatively correlated than with the stock market. So why did I buy a house if house prices are going to go down? Well, real estate takes longer for prices to adjust than the stock market. As well, there's a lag effect between interest rates rising and house prices falling. That's because people get FOMO, the fear of missing out. They're worried that interest rates will keep rising and they want to lock in a low interest rate before it's too late. That's what's been happening in Canada over the last several months. Here in Vancouver, housing prices have been skyrocketing for the last 2 years. I think they'll keep going up, at least in the short term, because inventory is just so low. Houses are currently selling with multiple offers, and open houses have lines down the street. One complex where townhouses were going for $350K in 2015 is now selling units for over $1 million. Those same units were going for only $850,000 in October of 2021. That's a staggering pace of growth. Of course, this probably won't last, but at least there is some stability here compared to the stock market where prices can fall 50% in a few hours. So what's my plan? Well, I needed a house, so I bought one. My wife and I are expecting our first son in April. We're going to live there for a while and keep monitoring the stock market and the housing market. If it looks like interest rates are going to keep rising, we may sell and move to a cheaper area. There are a lot of companies that I want to invest in long term, even though the market may tank now. So I'll start buying back into the market around the same time that Kevin does in March, once interest rate fears die down. I'll also be watching for an inflection point down in CPI, as this correlates well with market performance. Of course, if your strategy is to buy and hold over the long term, like greater than 10-year time horizons, any downturn is just a blip. Trying to time the market is probably stupid, and I could easily lose this bet. But for me, it's not really a bet. It's just taking care of my family. I personally think that we are at the end of a long-term debt cycle, and that governments are basically stuck between this rock and a hard place for the foreseeable future. Does this mean that we'll see negative returns forever? I don't think so. Innovation keeps going, and productivity keeps rising. So I'm optimistic that great companies will continue to be great and that there will be opportunities to keep investing in the foreseeable future. While I'm not optimistic about the US or Canadian dollars long term, I do believe that owning real assets like houses and great companies that will be profitable long term is still a good idea. Even if we are on a decline and massive change does come, there are always opportunities to grow your wealth. Just make sure that you are paying attention to what is happening in the world and seizing opportunities that arise. So what do you all think? Am I crazy for buying into the housing market now? Let me know what you think down in the comments below, and be sure to smash the like button and subscribe if you found this video to be interesting. For now, that's all. We'll talk to you all in the next one. Peace.